Let's jump right into this explainer, guys. We spend so much time obsessing over the flashy parts of the economy, but today we're going directly under the hood. We're going to uncover the hidden, kind of boring, but massively powerful force that is literally holding the entire global financial system together. We're talking about a multi-trillion-dollar mechanism that silently dictates the flow of global capital. Seriously, think about the massive contrast between the loud, flashy headlines we're all doom scrolling through every single day and the quiet, behind-the-scenes duct tape that actually runs our economy. I mean, we're out here constantly worrying about AI bubbles, political theater, every little rumor from the Federal Reserve. But guess what? The actual biggest risk to global liquidity isn't any of those things. It's Japanese government bonds. I know, it sounds incredibly dull, but trust me, it is absolutely the most important asset on Earth right now. So let's talk about the market's hidden duct tape and why Tokyo essentially controls your wallet. To get there, we first need to understand Japan's decades of zero, the 30-year economic pause. To really grasp why global financial conditions look the way they do today, we actually have to totally bypass Washington, D.C. and rewind the clock back to 1992 Japan. Following a massive, absolutely devastating crash in real estate and equities, Japan entered what everyone now calls their lost decades. Basically, zero real growth, zero inflation, just stuck. By the late 90s, the Bank of Japan did what desperate central banks do, right? They cut interest rates all the way down to zero. But, and here's the crazy part, even that wasn't enough. They were forced into a radical new policy. Their ultimate, desperate move was something called yield curve control. Now, I know that sounds super complex, but it basically just meant the Japanese government superglued their interest rates straight to the floor. They artificially capped long-term bond yields, completely guaranteeing that Japanese government bonds paid virtually 0%, and they kept this up for literally decades. Okay, so put yourself in their shoes for a second. Imagine you're a massive Japanese pension fund, a life insurer, or a huge bank sitting on just billions in cash. The math essentially forced you into a corner. You have to make a billion-dollar choice. Do you just accept a 0% return on your giant pile of cash at home? Or do you go shopping overseas for yield? Well, naturally, they chose the latter. They packed their bags and embarked on a multi-decade global shopping spree. Which brings us to the core focus of this explainer, exactly how the carry trade works and the math behind this global ATM. So how exactly does this global ATM actually function? Well, it's called the yen carry trade. And guys, it is essentially a financial cheat code. Let's imagine an investor named Bob. First step, Bob borrows a ton of money in yen. Remember, the interest rate over there is basically zero, so this is practically free money. Step 2, he converts that yen into US dollars. Step 3, he uses those newly converted dollars to buy safe US treasuries that are yielding, let's say, 4%. And finally, step 4, Bob just sits back on a beach somewhere and pockets the spread. He's generating massive, steady returns using money that literally cost him absolutely nothing to borrow. Now, multiply our friend Bob by thousands of massive global institutions, and suddenly you have trillions of dollars flowing like a river straight out of Japan. And because their borrowing costs were basically zero, they definitely didn't just stop at safe government bonds. Oh no, they bought US treasuries, sure, but also high-growth tech stocks, global real estate, emerging market assets. Basically, if it had a pulse and it yielded more than zero, Japanese capital bought it. They were pumping trillions in Japanese Wi-Fi straight into global markets, connecting and inflating everything. But what happens when things shift? Let's look at unwinding the global ATM and how the math completely flips in 2024. You see, this entire multi-trillion-dollar machine relied on one very fragile assumption. The Japanese yields would stay near zero forever, just indefinitely. But in 2024, that assumption spectacularly broke. For the first time in 17 years, nearly 2 decades, the Bank of Japan actually raised interest rates. The era of free money was officially over, and it absolutely spooked the markets. And the shockwaves from that rate hike, they were immediate, and they were brutal. The S&P 500 dropped a quick 6%, but the Japanese index, the Nikkei 225, it plummeted a staggering 12% in a single day. That was its worst drop since 1987. This wasn't just, a bad day at the office. This was the terrifying moment investors realized their endless cheap global liquidity was evaporating right before their eyes. This single move caused a total structural shift in global finance. Look at it this way. Under the old math,
Cheap borrowing plus cheap currency hedging equaled super high profits. It was a no-brainer. But under the new math, because Japanese yields finally rose, borrowing that yen suddenly became way more expensive. Hedging that currency risk, also way more expensive. So suddenly, that 4% US Treasury doesn't look so insanely profitable anymore. The math flipped. And when the math flips like that, capital panics. It triggers a massive repatriation, literally forcing trillions of dollars to sell off global assets and rush as fast as possible back home to Japan.
Which brings us to the backbone of all markets, and why the bond market truly dictates everything. To bring this directly home to your wallet, let's look at what legendary investor Ray Dalio says, because he perfectly summarizes the stakes here. He says, the bond market is the basis, it's the backbone of all markets that determines what all asset returns are going to be. Think about that. If the bond market breaks, absolutely everything sitting on top of it, stocks, real estate, corporate growth, it all fractures. This is exactly why we should be obsessing over the global supply and demand for bonds, rather than, say, hyper-analyzing every single cough or pause in Jerome Powell's press conferences. There's actually a really critical split in how interest rates work that a lot of people miss. Short-term overnight rates, yes, those are indeed controlled by the Federal Reserve. But long-term rates, the 10-year, 20-year, and 30-year yields, those are driven entirely by global supply and demand. For decades, Japan provided massive, reliable demand, constantly absorbing our debt. So it's actually the sudden lack of Japanese demand moving forward that truly dictates our crucial long-term rates. Okay, so here is how all of this abstract math actually impacts you in the real world. If the US keeps running trillion-dollar deficits that require constant, massive debt issuance, and our single biggest buyer, Japan, steps back, well, yields have to rise to attract new buyers. There's no way around it. And that infects every single part of your financial life. Stock valuations shrink even if company earnings are actually good. 30-year mortgage rates stubbornly refuse to drop, which keeps housing totally unaffordable. And corporate credit tightens up, slowly choking the entire economy.
Which leads us to our final, absolutely critical question. What actually happens to the global oxygen when the world's biggest ATM closes forever? As liquidity tightens up globally, you have to realize that the biggest threat to your portfolio isn't the loud headline hiding in plain sight. It's not an upcoming election, and it's definitely not an AI bubble. No, the real danger is the silent, ongoing unwinding of the cross-currency carry trade. The very cost of money is changing everywhere. So keep your eyes on Tokyo, because the quietest engine in the market is about to make the most noise.